Well, November has brought turbulence back into the market, and there's a few things that are taking place. Investors are starting to become much more fearful, and we're starting to see profit taking on high-flying stocks take place. The stock market in the past week alone seesawed higher and lower throughout the recent week, ending the week down 1% on the S&P 500. Small caps got hit particularly hard, with the iShares Russell 2000 ETF, IWM, down more than 3% on the week alone. And just for your reference, small caps do not do well when the economy starts to falter. And in today's video, we're going to cover a lot of investor questions about the stock market right now. Are things getting worse? Should we be taking profits right now? Is the market and the economy headed towards a recession? So before we jump into these topics, do me a huge favor, show your support for the channel just by simply clicking that like button down below. It greatly helps me with the growth of this channel. I appreciate it. Subscribe as well, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a closer look at this S&P 500 small pullback that we have seen and ask ourselves a few questions. Is this something that's going to intensify, or is this just a small blimp in the longer scheme of things? Looking here at this chart, we can see the S&P 500 has been climbing nicely along the 50-day moving average for much of the past few months, and we have a longer-term trend support line below 65.75. We were able to regain the 50-day moving average on Friday to close, but we did dip below momentarily for just the second time since the end of April, and that second time was just a week prior. And again, as I've been mentioning a number of times on plenty of my recent videos, and especially within my Discord community, the Stock Investor's Edge, there's a lot of headwinds that are really starting to line up against investors. And what those headwinds have brought is fear. And as you can see here, we're taking a look at the Fear and Greed Index. Fear levels have crossed over into extreme fear territory over the course of the past few weeks. However, as Warren Buffett has long said, we should be fearful when others are greedy and greedy when others are fearful. So yes, that is seemingly good advice to go by. But again, this isn't a major pullback we've seen. We're just 3% from all-time highs. Is this something that's going to intensify? And when we take a step back and zoom out, we haven't really seen much of a correction at all since dating back to March and April at the beginning of the year. Speaking of that dip, from that trough to the peak we saw just a few weeks ago in the S&P 500, the index has climbed 40% after bottoming out during the tariff tantrum in April. So to say we're overdue for a breather would be correct. However, when it comes to investing, we don't just fall into corrections just because we are overdue. We need to look for specific reasons, which usually could consist of any number of things, from valuation concerns, labor market concerns, lack of economic growth concerns, or even geopolitical concerns. And many of us investors could take a step back right now and say, well, we're actually dealing with all of those things right now to some degree. Let's first begin with valuations. And according to FactSet, analysts are looking for the S&P 500 to generate EPS of $300 per share in 2026. Thus, with the S&P 500 trading at 67.34 as of the close of Friday, that gives the index a forward PE multiple of 22.4 times, which is well above their 5-year average of 20 times and well above their 10-year average of 18.7. And sure, there are going to be plenty of you that are going to be saying, well, look at the tech exposure that we see in the S&P 500 today as compared to 10 years ago or 20 years ago. So let me first talk about that here for a second. On your screen here, you can see a sector breakdown of the S&P 500 back in 2015, so a decade ago. And what do you see as the top sector? Well, it's technology, accounting for nearly 20% of the entire index. So really the positioning has not changed. And you can go back a number of years and see really technology and financials are usually 1-2 at the top of the leaderboard. The only thing that has changed is the amount of exposure to the likes of technology over the past decade. Looking here, you could see today's weightings, where technology has now shot up to 36%, nearly doubling what we saw just a decade ago. And looking back at history, very rarely do we see the top weighting in the S&P 500 break above 20%. But when was the only time we saw it break above 25%? Well, that was during the dot-com bubble, which peaked out in March of 2000 before the crash ensued. So do I dare say that we're in an AI bubble? And for a number of months, I've been saying no because the spending from a lot of these companies has been backing that up. But what we've been seeing lately has me kind of changing my tune. Looking here now, you could see that we have this nasty web of transactions that are starting to take place. NVIDIA invests in OpenAI and they turn around and buy NVIDIA chips. OpenAI spends billions on a cloud deal with Oracle. Well, Oracle spends billions on those NVIDIA AI chips. And that's just one example. There are a number, and you could see AMD on the list there as well. Elon Musk, XAI is another company, raising money, $20 billion to be exact. And one of the companies funding that is NVIDIA. And what is the funding for? NVIDIA chips. So yes, there are definitely bubble-like signs that are starting to creep up. And when you combine that with high valuations, definitely the level of concern increases. Now let's move over to the labor market, which is another key piece of investing success. And the labor market has been a bit tricky over the past few months because we've been dealing here in the US with a government shutdown. So we really haven't been getting much data. However, now that the government has finally been reopened, we are expected to get September jobs report this coming Thursday, but with a caveat. It won't include an unemployment rate, and the reason given is because that part of the survey was not conducted during the shutdown and is not easily replicated as the jobs number itself. So that will be a key report we want to pay attention to as investors. However, there are still employment reports that came out, specifically from Challenger, which is a notable third-party company. And as you can see here, job cuts in October were the worst we have seen in more than 20 years. Worst month since 2003. And according to Challenger, we saw 153,000 job cuts in the month compared to 55,000 in October of 24. Through the first 10 months of the year, we have seen over 1 million job cuts. That's up 44% from the prior year over those first 10 months. And technology has led the layoff story. Obviously, one part of this is going to be the efficiency that AI is starting, the impact that AI is starting to make. Hence why some businesses are saying, well, if AI is doing this, why do I need to pay a human to do this particular job? But we can't put all of this on AI. We are starting to see that cycle of a recession when we've been dealing with inflation for a number of years. So businesses can't really increase prices all that much. However, they've been spending so much. A lot of that spending has been on AI, which could impact their earnings. So in order to get earnings growth again, they have to cut the so-called fat in the middle, which is employees. And by reducing employee headcount, that could once again bring up earnings growth. But it's a revolving cycle because if a lot of people start getting laid off, consumers don't have money. And if consumers don't have money, they don't have money to spend. And that's when we start heading towards a recession. Now again, I'm not here calling a necessary recession. I'm just saying we're starting to see a lot of signs pointing in that direction. But regardless of whether we dip into a recession or not, I'm here to help you along the way, where we talk about stocks and options on a daily basis in my community, the Stock Investor's Edge. And beginning today through the end of the month in November, we are running our Black Friday sale, which is the single largest sale we run during the year. So take advantage of this opportunity to get 30% off all of our subscriptions by using the link down in the description below. And with that being said, we're going to move now to the economy. And as I talked about, that revolving cycle that heads towards a recession starts with consumers. And if consumers aren't spending money, it's going to impact the economy. But one of the biggest drivers of the economy year in and year out usually is that of real estate. And the housing market has been in shambles for a few years. However, rates are expected to come down, which could provide some reprieve. But new foreclosure data for the month of October just jumped 20% year over year and up 6% on the month, showing that there is no end in sight for the real estate. In fact, that market could get worse, as completed foreclosures were even higher at 32% growth year over year. Looking ahead to 2026, analysts are expecting the US GDP to grow by just 1.8%, which is not all that great, not terrible, but still a positive number. And I think the way it's going to work is we are still around that 3 to 4% rate in 2025. So things could start okay and start to dwindle as the year goes on. And lastly, there are plenty of trade deals still to work out that could impact the economy. Trade deals, the largest being with China, still large trade deals with the likes of Canada, India, and the list goes on. And add on to all of that, still some geopolitical potential tensions. Talk about what's going on in Venezuela, the US keeping an eye on what's going on with Russia and Ukraine, and also keeping an eye on China seeing Taiwan. A lot of headwinds in the market. So when we get back to the chart though, we can see that 6,600 here is a likely next stopping point or support level, which again is only 2% from where we're at today. However, we can utilize the options market to help gauge where option investors foresee the market heading. And right now I'm going to focus on the December 19th puts of the S&P 500, which is about a month from now. We can see some heavy put buying at the 655 level, the 650 level, and down to even the 640 level. I'm keeping a close eye personally on that 650 level when talking about the SPY ETF, where investors have nearly 90,000 contracts open at that particular strike. And a move lower to 650 on that SPY ETF would equate to a pullback of nearly 3.25%. The 640 strike would require a near 5% pullback from current levels, which would put us close to that 10% correction level. So if you wanted to hedge your portfolio to protect it in some degree from any downturns, you could utilize an option strategy like a debit put spread. And this is one that I recently added into. It's a low cost one. You could buy to open the 12/19 650 put, and at the same time you could sell to open the 12/19 640 put. So we're buying a put and selling a put. This spread would cost you a net difference of $1.60 or $160 per contract. And if the SPY ETF were to fall down to 640 or lower, your max profit on this investment would be $840. Again, if the S&P 500 stays above 650, hopefully that means the rest of our portfolio is doing well, thus this option contract would be a loss. So again, looking ahead, there's a lot of concern for investors. There's a lot of headwinds. However, when it comes to this stock market, if we could name this particular stock market in 2025, that name would be resilient. This has been a resilient market. And coming along the road is December, the Santa Claus rally, which is usually one of the best performing months of the year. So maybe we could get one more bounce higher before we see a lot of these headwinds and the final drop in the markets take place. Down in the comments section, again, let me know what are your thoughts on the market heading into the remainder of the year and in 2026. And if you're not yet part of the Stock Investor's Edge, make sure you take advantage of our Black Friday sale, which will be going on through the end of November. Again, check out that link down in the description below. And if you found any value, show your appreciation again by simply clicking that like button, subscribe to the channel, and we'll see you in the next one. Take care.